All right, thanks everyone for reading through those disclosures. As I said, my name is Natalie Beckett, and I will be your moderator for this afternoon's free educational webinar. Like I said, today we have Wendy Kirkland with us, and Wendy is going to be talking about broadening your option investing horizon. Wendy, are you with us?
I'm here. How is everyone?
Wonderful. Thank you so much for coming on, Wendy. We have a great turnout today, and I'm really excited to host you. One of the responses I always get after we have a webinar with you, Wendy, is, when's she coming back on? I love her webinars. There's always so much information. So we're always really happy to have you, and glad you could come on today.
Thank you very much. I'm happy to be here.
Wonderful. So I'm going to go ahead and give Wendy the reins, and she'll get going. But while I do that, I want to make sure everyone knows, if you guys have questions throughout the presentation, please put them in the Q&A or the chat box. And I will compile those questions and get them over to Wendy at the end of her presentation, time permitting, okay? Wendy, I just sent the reins over to you if you want to share your screen. Perfect. I can see it now. And if you guys have questions regarding speakers or any other issues, just put them in the chat or Q&A box and I'll address those. Take it away, Wendy.
Thank you very much, Natalie. I appreciate it. Appreciate all of you coming and spending a little time with us this afternoon. I'm hoping there it goes. Hoping my voice is going to hold out. I have been nursing a cold for a week, and I feel like I'm about over it, but it's still, there's a little tickle in the throat. For those of you who do not know me, I'm a full-time trader, been trading for about 12 years at this point. I administer a number of advisories, have written several strategy books, both long and short, relating to different patterns and different time frames and so on. Toward the end of this presentation, I'll give you my website, and you can check them out if that suits you. Most of us come to trading by different paths. Some of us might have someone in our family that's involved, or maybe it's our education that brings us to the stock market. Some people maybe are in banking or some other financial endeavor, and a lot of us come to it through financial needs, and that is how I started as a trader. That just like we had with the hurricanes that have come through recently, I live in the mountains of western North Carolina, and you don't think of the mountains as having problems with floods. But in 2004, hurricane, then tropical storm Francis came through, and Ivan 2 weeks later, and it dropped just a ton of water, a deluge of water, to our retail gift shop that we had in historic Biltmore Village here in Asheville, close to the Biltmore Estate. And it wiped us out. We had everything involved in our store. It was our retirement, our weekly income, our college fund money. It was just there, and everything was wiped out. So I heard about option trading through Broaden and took a few little classes, and really just enough to get into trouble. And so from that point on, every time I found that I had difficulty or I didn't understand anything, I would research it, get a book on it, read it, study, conquer it, and eventually I got to the point where I was achieving more positive trades than negative. And so what I would like to do today is to share just some of those nuggets that I learned that you will be able to apply right away. At that time, my personal goal was to achieve financial independence. And once I moved beyond that and that need was kind of satisfied, I decided that if I could do it, I could share and help other people achieve the same objective. So that's when I started writing the strategy books. I do a couple newsletters, offer coaching and advisory services, which Money Block, Avant-Garde, does the auto trading for, so which I appreciate very, very much. I too need to show you this disclaimer, and the real gist of it is that you don't want to trade with money you can't afford to lose, that there is risk in trading and you want to be well aware of that. So we're going to cover, I guess, 6 points, but basically 3. We're going to first discuss trading times during the day and when that is best to do. Next, we're going to figure out how to zero in on the very best trade candidates and how to create a list of those candidates so that we're not really wasting our time on equities that don't have the very best potential. And then we are going to jump into the 3 essential elements that you need really to have the very best trades. I'm not saying they're only trades, but the very best producing trades. So let's get started here. The optimum times of the day to trade are broken up into a couple periods. The first hour of the trading day, and it really isn't a 60-minute hour, it's more of an initial period of trading. And this is where the orders that were placed overnight are filled, and there's always or usually a knee-jerk reaction to whatever is happening in the news that becomes instantly built into the market. And this is where you have your gaps up and down. And this first hour or this first period is often called rookie hour or amateur hour. And this is the time when new traders see this morning move, they get all excited, maybe they even see it pre-market. The market's going to open up $60 or whatever, and they're ready right then at the first get-go to jump in, have their order filled, and then as the market fills these orders, it settles back down and their premium drops. Now, this doesn't mean that the market might not climb right back up to where it was, but what it does mean is that you, as a trader, might have been filled by a lesser premium, and then eventually it will move past where you bought, and then you'll be in the profit zone. But you could have made even more if you hadn't jumped the gun and that you waited to see what was going to happen after this first initial rookie period. And then the last hour of the day, again, not really a 60-minute hour, is called professional hour. And this is where the professional traders and the money managers and so on often take profit or make their purchases for the next day. So we can kind of divide our day out and say that between 11:45 and maybe 2:15 can be a long lunch hour. And during this period of time, stocks will often slip back as traders take a break to eat and then return in the afternoon. If you are, say, in a put option trade, sometimes the lunch period can work to your advantage. Maybe you're thinking about closing a trade, but rather than doing it at 11:30, maybe it's a good idea to wait till 2 o'clock, and maybe it would have slipped just a little bit lower. So in a nutshell then, the morning session can be anywhere, say, between 10 o'clock, 10:15 in there, on into noontime. The afternoon session is between, say, 1:30 to 1:45 to then close at 4 o'clock. And again, the minutes are not hard and fast. These are periods. And once you start paying attention, you'll be able to pick out and see when the reversals take place. Now, I've covered these little rough time zones, and you have to realize that what I'm saying doesn't have anything to do with whether the market will be up that day or down. It has more to do with the transition periods. And this is what we'll look at a chart and pick these out. So on this chart from the video, you can actually see this kind of doji candle right here is the first opening 30-minute candle. And it opened positive, went way up to the top of that candle, dropped lower, and then settled right smack in the lower bottom, the lower third, say, of that candle. So here it opened high and ended up closing at the lower third of that range. If a trader during that first 30 minutes had said, oh, I'm so excited, this is going to be a great day, I'm getting into this trade, they could have been filled way up here around 170, 175, and actually, if had they waited, they could have gotten in somewhere around $71. And by the time it made it back up that 75 cents, they maybe could have made half of that, depending on what strike and delta they were entering in. So it's better to let that first period settle out and then enter. And so it's marked here saying that it's a better entry after the market settles. Then it climbed all the way up here into the lunch hour, slipped back, and then dropped during the afternoon session and kind of went flattish for the rest of the day with kind of a bearish slide, and ended up closing lower on that day than actually where the first candle closed. And so this is the professional hour sorting out what they're going to do for the day. So there actually maybe could have been a couple trades in here, depending on the time frame that you actually trade, where you got in after the first half hour of trading, went up to the lunch period, and closed your call trade, and then got in a put trade later in the afternoon and kind of ridden it down for the day. But the point is not so much trading this particular stock and the quick in and out. It has more to do with the periods that I was describing to you. And if you incorporate that understanding in your trading, you are going to come out on the better side. So now next we're going to start creating our list of the best stocks that have the most consistent big moves. And the way we're going to do that is to add an indicator called the average true range, or ATR. And I've added that down here to the bottom of the chart. And what this does is it gives us a reading of its average moves over the period of time that we have it set for. And so I have an ATR here of 14. I have it on a daily chart because we're worried about what it's going to move in a day. And I can look at this stock and look and see that it's trading for $101, almost $102. And so a 2% move per day would be $2.02. If I look down here on the ATR, it is $2.15. So this makes a great candidate. I would put this on a list of stocks that I want to check daily and see what patterns and what's happening with that stock and create a trade list of good candidates. Here's another equity. Weren't we just on the video? Maybe, or maybe it's a different time period. Anyway, what I have discovered is that a 2.5% to 5% move in price often equals a double in weekly option premium. So here, if you are selecting stocks that you want to trade that are moving between, say, 2% a day, that's your criteria, you are very close to a double if it moves that up or down every single day. A 3 to 5% move works out to be a double in a monthly option premium, which is usually further out in time and is a little pricier to get into right from the get-go. On this particular time frame of this chart that I'm looking at, the price is 70. And so $1.40 would be 2%, the easy math. And if I look down here, I can see that the ATR was $1.68. So again, it shows this as being a very good candidate because it is over 2% on average move per day. And that's how you create a list. You can maybe use a scan, stock charts, maybe it lets you do free scans. I don't know, I said that now, and I'm not sure if they do free scanning or not. I know they do free charts. So you could set up a chart with the ATR, and that would be free. But maybe not do the scan. But there's other free charting programs and scan programs so that you could maybe even run a scan and find the ones that move on average 2 a day. Otherwise, you put the ones in and run it through this criteria. All right, so the next essentials that we're going to look at, and again, I have found that the very most successful option trades have 3 things in common. And the first is that they are either overbought or oversold, that there has been a reversal and a new confirmed trend has started, and then it gives a confirmed entry signal. So we are going to add some chart indicators to help us work through this. So the first one to determine overbought, oversold that I have added is the Channel Commodity Index, which is just simply referred to as a CCI, and I have set that parameter at 34, which smooths out some of the swings. And if you have it too tight, and say you had it set at an 8 or a 10 or something, then it's going to weigh every 8 or 10 candles, and you're just going to have lots of choppy swings back and forth. So I found that the 34 kind of helps smooth things out. The brown areas are where it's oversold. The green areas are where it's overbought. It can sometimes stay in one area for a period of time and then drop. You can see here often it had a couple little bumps of being oversold, then it went to being overbought, had a couple bumps there, and then went to oversold again and overbought. And each time it had kind of 2 little humps. And at least for the moment, that sort of seems to be its pattern. Now, I've done a publication that I call the fins, and this is what it kind of refers to in that particular book or publication. I refer to these peaks as being like fins of a fish, so that you can have your sharp fins and then you have the lower fins. And as a natural tendency, price will go from being oversold to overbought, back to oversold, back to overbought in a pretty routine fashion. And some traders will look at this and they can just almost use these signals as entry and exit signals. So what I'm suggesting that you watch for is a move above minus 100 so that it's going from oversold and moving into a new direction, meaning a new trend. Then we look for a move down from 100 when it's overbought. Now, we're not using just this one signal because you can see here when we went from overbought, went down below 100, then flattened out for a day or so, and then went up higher, and then finally dropped back below the 100 line, and that's when you had your big drop to become oversold again. And then it did the reverse. You went above the minus 100, flattened out for a day, dropped lower, and then went up the second time. So seeing this as its pattern, I would be watchful, and here it did it again as far as being overbought. But other equities might not have the two bumps. Maybe they only have one, and they have their own kind of little pattern that develops. But the point we're going to look at is the moves between the 100 line and the minus 100 line, and we're going to incorporate that with other indicators. So they're going to be confirming each other and helping us to zero in on the very best trades. So the difference here is the fact that we've changed time frames, and the same indicator can be used on various time frames. It's not like it just, I think that other chart, let me look real quick, was a 30. Yes, it was a 30-minute chart. This one is a 60-minute chart, and does the same thing. You have it overbought for a period of time, went down to being oversold, up and down, went to being overbought, dropped and flattened out, and then went up higher. It's just a slightly different picture that it gives you, but it will work on a daily chart, a 10-minute chart, whatever you happen to be using. Okay, now the second element that we're going to add, second indicator aspect here, is I have added a percentage price oscillator, a PPO. And it's two lines. It's black line and red line here. The black line crosses down. That is showing that the trend is heading downward. If you look up on the chart, you can see price has gone down. Here's another little cross up. Price went up for a portion of the day, crossed back down here on the 25th, and price dropped again, crossed back up. And so price is going to move in the direction of the cross. If you don't happen to have a PPO on your charting software, you can use the MACD, the MACD indicator. They're pretty close. So this is our second indicator that we're going to incorporate in this process. So we are going to be looking for a cross up over the minus 100 line, and we're going to add in a requirement of wanting to see a PPO cross up in the direction that we would be considering a trade. And in this case, on the 7th, it would be up. We're moving up over minus 100. We're going to be looking for a cross up of the PPO indicator. Here's just one more example to just kind of see that what I'm showing isn't really a fluke. That again, you can see the peaks or the fins going from oversold to overbought and back down again and then back up, and it can stay in that area for an extended period of time, and this helps you to visualize what you might expect to happen next. If we look at, this is Coca-Cola, it has risen for the whole month of September. And you can see that it's overbought, but it can stay up there for a good while. If we look at the PPO indicator, that we had a cross up over the minus 100, then it kind of tested it there. And that's just about the time that we had the PPO cross up, the black line over the red. Stayed that way, came down and tested it a few times, but the overall trend for this whole period has been up. Okay, now one of the things that I am known for is a pattern called a P3 pattern. And this kind of brings all of these elements together. That what the P3 pattern is, it's a squeeze. This is our PPO line up here. And I've added another indicator, the ADX, and that's this lower line. I'll show it on a chart in a minute. But these lines have squeezed together. Now, I don't really feel like I need to show you any more than that, and you're going to be able to pick these out on a chart. So this is the first one. This happens to be cell gene. And this area that I have circled is where the lines have squished together. That I've added this ADX line. This is a strength line or momentum line. It doesn't show you which direction the trend is going. It just shows you that if it's rising, strength is moving into the trade. If it's dropping, like it has here between the 25th and the 26th, it's dropping. Price momentum or strength is coming out of the trade. And then here late in the day on the 26th and into the 27th, it rose. And you look what we have, a big, huge gap. So we have our initial squeeze pattern. We have it oversold. It has risen above the minus 100 line. We have a PPO cross so that we know that a trend change is taking place. It's got a long way to move because it's been oversold. And the squeeze pattern suggests that then is getting ready, almost like a pressure cooker, ready to pop. And it did, and gapped up. And we just can take our money right there and not weather this period where it then flattened out and eventually had the PPO cross down. Here's another example. Now, I didn't circle this one because I figure you're going to start training your eyes to spot this pattern. And it's right here on the 25th. This is Costco. And you can see that the lines have squeezed together. The equity has been oversold, and right here on the 26 has risen above the minus 100 line, kind of flattened out. We had a PPO cross late in the day, and I marked a place here on the 29th where it might have had an entry, and then it rose for the next few days and noted an exit period. And again, this pattern as it plays out goes through very specific stages, and you will get so that you can learn what those stages are and be able to look at any chart and be able to anticipate what is going to happen next and what direction and how it might move from there. So there are times, and I have traders always ask and say, will a squeeze always go up? Does it always play out? And there are times, and I noted here, this is lows, that there are, had the PPO cross, the lines kind of pushed away like it was getting started, and then it fizzled out. And we had a PPO cross back down again. And you can see that this was right after the CCI had confirmed, in a sense, by crossing over the minus 100 line. And it went up just a little bit, and then it went back down again. The fact that this area where it was oversold is deeper, lower than this one is kind of a divergence suggesting that it's apt to go up again. So it formed another squeeze. You can see, again, the lines came close together, had that squeeze pattern. PPO crossed up. It had been oversold, got started, and then it dropped one more time. It went up a little. Here we have an oversold area, and then it dropped again and formed another squeeze. And it wasn't until this third one that all the areas of support had been tested, and then it was really ready to go and start this new trend. So if you look very, very closely here at the 15th, answer to the question, will it always go up? And the answer is yes, it will always go up a certain amount. So if you look here on the 16th, it, as the PPO crossed, as the CCI crossed, it went up a little bit and then flattened out and then eventually rolled over and went down. So this is where you want to have your stops in place. Get out of the trade, cut your, it close, you might get out at even or a little bit of a loss. And then even if you got in on this second time, the same thing. If you look close here, it went up really for 2 days. And then it gapped down, which really could have probably caught you in this drop. It formed this third squeeze, and then that is when it started back up again. So you learned what to expect of the stages that the pattern, the squeeze pattern, is going to go through, and how to set up your trade plan is what I'm trying to say, so that you have your stops, know when to get out. And this cuts out a lot of the guesswork because you have learned the stages that the pattern is going to go through. So here's a couple squeezes. Again, I'm sure you can pick them out at this point. There's one right there. And this kind of played through and went through its pattern. This is, again, a 30-minute chart of bowing. And went from, say, 235-ish up to almost 241, if my eyes are drawing straight lines. And its pattern played out. Then it flattened out for a couple days, went up for another little pop-up, and then dropped back down. Formed another P3 squeeze. Again, you had it oversold, crossed up over the 100, waited until the PPO crossed. You're not getting in here or there or whatever because it was continuing to drop actually. Through this period, you're tying in, waiting for your PPO cross up, and then again it rose and went to a point where it was overbought for a period of time. And so my strategy books where I am teaching the P3, and then there's also a P3 and a half short pattern, goes through all of the stages so that you, as you're looking at this, can anticipate what is going to happen next. All right, so this is I just mentioned the P3 and a half short pattern, and this you're going from being overbought and dropping down below the 100 line, and you can see that it drops down here and becomes oversold, and then it has stayed here for a period of time. So if we kind of look at this in reverse, we have a TPO cross down. We have been overbought, crossing below, and the lines kind of pushing away from each other and dropping down. And so you've got in up here before this gap down, and then have been able to write it down, go ahead and get out, take your profit, and go ahead and miss this period where it's been trading flat and move on to the next trade that's, going to be fresher and newer, and not that it has been sold. Did I say overbought? Anyway, oversold for a number of days. You want the fresher trade, the ones that it's just at the beginning of having been overbought, moving toward oversold, having the PPO cross down. So that kind of covers the two patterns